Listen closely, stackers. I need you to burn a number into your mind before we proceed here. Not a forecast, not a fantasy, a closing price, $79. Just 2 days back, this market was asleep. 48 hours ago, silver was trading in the low 70s while most of the world was carving turkey and pouring wine. And yet, while the headlines were totally quiet and desks were empty, something extraordinary happened beneath the surface. On Christmas Day, I turned on this camera for one sole reason. The data frightened me, not the chart on television, the liquidity data, the calendar, the structure of the market itself. I warned you about what professionals call ghost week, that dead zone between Christmas and New Year's when liquidity evaporates, when price discovery happens in dollars, not pennies. In that thin vacuum, markets don't walk, they lunge. And that is exactly what we saw happen. Silver didn't grind higher. It didn't politely rally. It detonated. One vertical session carried price from the low 70s straight through 75, 76, 77, and slammed into the high 79s. An $8 candle in a single trading day. Moves like that don't belong to calm markets. They belong to markets that have broken free from all restraints. This is what a true blue sky breakout looks like. When an asset clears all-time highs, resistance vanishes. There are no trapped sellers, no overhead supply. Everyone is suddenly in profit, and when that happens, price doesn't climb the stairs. It takes the elevator up. Here's the part that should make you lean forward. Despite silver becoming the best-performing major asset on the planet, outperforming stocks, outperforming tech darlings, outperforming even crypto, the mainstream financial media barely whispered about it. That silence is not accidental. It is your huge edge. Because markets don't end in silence, they end in noise. And right now we are still in the stealth phase. But that phase is ending faster than most people realize. And tonight I need to show you why this move didn't start with retail traders and why what comes next is far more dangerous and far more profitable than anyone is really prepared for. Now let's address the real question. Why did this move happen so violently and so fast? Ghost Week explains the conditions, but it does not explain the ignition. Low liquidity is gasoline. Something still had to strike the match. And what did was not emotion, not hype, and not retail speculation. It was pure mathematics. Early this morning, a signal flashed on institutional dashboards that most investors will never see. A signal so rare, it has not appeared since the last great precious metals cycle. Pension funds, sovereign wealth funds, and university endowments do not trade stories. They trade ratios, they trade valuation dislocations alone. And today, the most important ratio in the metals market broke. The gold to silver ratio collapsed below 60. For years, that ratio lived at 80, sometimes 90. The message was clear: gold mattered, silver didn't. But when that ratio compresses under 60, the message flips instantly. It tells asset allocators that silver is historically undervalued relative to gold. Look at the numbers: gold above $4,500, silver near 79. To an institutional allocator, this isn't excitement, it's arbitrage. If you need exposure to hard assets in an inflationary, unstable world, silver offers dramatically more leverage per dollar than gold does. This is why today's move wasn't retail FOMO. It was front-running. Traders who understand how institutional models work were positioning ahead of what comes next. Because when investment committees return from holiday, the models don't hesitate. They rebalance automatically now. And here's the critical asymmetry. A few $100 million moving into gold barely registers. The same capital moving into silver overwhelms the market. Silver is thin. It doesn't absorb flows. It reacts explosively to them fast. That's why 79 doesn't feel like resistance. It feels like gravity. The market is already anticipating buyers who haven't even arrived yet. And when they do, the collision between institutional demand and a deeply short banking system will turn volatility into something truly more dangerous. Now we have to talk about who is about to move this market, because the next leg won't be driven by retail excitement. It will be driven by institutions, the kind that manage trillions, and their timing is everything here. These players don't react like traders. They move on schedules, committees, and mandates. They went on holiday with silver around the low 70s. They are coming back to a market pressing 80, with the gold to silver ratio already signaling rotate. When those desks power up, they won't ask whether the move is too fast. Their models will ask one question: is the portfolio misallocated relative to its rules here? And that creates a different kind of urgency. In the institutional world, you don't get fired for being wrong in theory. You get fired for underperforming in practice. If silver is up massively and your fund has zero exposure, clients don't want explanations. They want results. That pressure forces late buying, and late buying in a thin market creates vertical price action. Here's the danger: institutions are not price sensitive the way retail is. They don't wait patiently for the perfect dip. If an allocation model triggers, capital must be deployed. Even a small rotation out of gold and into silver can be meaningless for gold, but catastrophic for silver because the silver market is tiny by comparison now. That's why this next phase matters. Speculation pushed silver through old highs. Institutional accumulation can push it into a different regime entirely. And unlike speculators, institutions don't flip positions for quick gains. They lock them away. When silver gets absorbed into long-term vaults, it doesn't come back easily here. So if you're staring at 80 like it's a ceiling, you're reading the chart the wrong way. This isn't exhaustion. This is the market pausing before a much larger force arrives here. Now we need to widen the lens, because if you think this story is centered in New York, you are already behind. The real price of silver is not being discovered in a single market anymore. It's being revealed through divergence. And the most important divergence right now is happening in the East now. While Western traders fixate on 79, the physical market in Asia is trading at a completely different level. On the Shanghai Futures Exchange, silver has been pricing consistently higher, signaling something critical. Physical demand is outpacing paper supply. When one market trades at a persistent premium to another, it tells you arbitrage is broken. And when arbitrage breaks, it's never because of lack of opportunity. It's because of lack of metal now. If the system were functioning normally, banks would buy silver in New York and sell it into Shanghai until the gap closed. That isn't happening. The spread remains. That tells us logistics are strained, vaults are thin, or the banks are unwilling to ship metal because they need it for themselves. None of those explanations are healthy now. This is why every rally in the West feels like chasing a moving target. As New York steps higher, Asia steps higher first. The price you see on your screen is lagging the physical reality. And when physical markets lead, paper markets eventually have to catch up violently now. This divergence matters deeply for institutions. When analysts run global pricing models, they don't just look at domestic futures. They look at where the metal is actually clearing. Seeing silver trade at a premium in Asia reframes the entire trade. It means Western prices are not expensive, they are discounted now. That perception is dangerous for anyone short the market. It turns every dip into an opportunity and every smash attempt into free inventory for the strongest buyers. And this is how markets enter what professionals call a reflexive loop, where rising prices create more demand, not less here. Silver isn't just breaking higher. It's being pulled higher by a physical market that paper contracts can no longer control. And this is the moment where price targets stop being technical and start being structural now. This is where the narrative shifts from exciting to dangerous, because divergence like this doesn't resolve gently. It resolves through force. And the force building right now is coming from the collision between physical demand and a financial system that was never designed to deliver metal at this scale here. While most traders were watching price spike, something far more important was happening quietly in the background. Futures holders were not taking profits. They were not rolling contracts forward. They were standing for delivery in a market built on the assumption that almost nobody ever asks for the metal, that behavior is radioactive now. December is supposed to be a quiet month, a transition period. Historically, deliveries are minimal because participants settle in cash and go on holiday. But this time, contract holders said no. They rejected paper settlement and demanded bars. That single decision exposes the fragility of the entire system now. Futures markets operate on confidence, not inventory. They rely on the belief that paper claims will never be converted into physical demand all at once. When that belief breaks, leverage collapses. Every ounce that leaves a vault is an ounce that cannot be leased, rehypothecated, or sold at 10 times over. It becomes sterile now. This is why delivery data matters more than any indicator on a chart. Price can lie. Sentiment can lie. But metal leaving the vault cannot be faked. It tells you that someone with size, patience, and urgency no longer trusts promises here. Here is the critical insight. Soaring premiums didn't crush demand. They ignited it. This proves the market is far from any equilibrium. In a sound system, high costs ration supply. But in a failing system, higher prices only validate the fear. We are at the point where volatility stops being random noise and becomes structural. The market isn't negotiating spot price now, it is negotiating availability, and when physical access is the question, the paper price is secondary. We must now address the strain physical demand places on the fractional banking system, as this is where the narrative truly shifts from commodities to systemic failure. When banks short metal they don't possess, the issue isn't volatility, it is a liquidity crisis. And liquidity remains the crucial lifeblood of the entire global financial ecosystem. When delivery requests surge, bullion banks are backed into a corner. They must source physical bars at rising costs or post cash to cover exposure. Both options drain balance sheets. This isn't theoretical. It hits funding markets fast. When banks scramble for short-term cash, they tap facilities meant to be used strictly during emergencies. This is why funding spikes matter. They are the true canary in the coal mine. When the cost of overnight cash jumps, it signals institutions are under pressure right now, not months away. It means positions once thought manageable are becoming unstable at the current manipulation levels. Here is the feedback loop few investors understand. As banks are forced to raise cash to handle delivery stress, they dump other assets. That tightens liquidity everywhere. Tight liquidity pushes the Fed closer to intervention. And intervention, by definition, implies more currency creation. Printing fiat doesn't solve the metal shortage, it amplifies it. More currency chasing the same finite silver pushes prices higher, worsening the bank's short exposure, which forces even more liquidity support. This isn't just a cycle, it is a death trap. Markets sense this trap long before the news catches up. That is why volatility accelerates instead of calming. Every spike in spot price is seen as confirmation, not excess. Every dip is viewed as a temporary gift, not a resolution. We are in the phase where planners lose control and are left managing symptoms. They can smooth funding markets, but they cannot print metal. When a paper system collides with a hard physical constraint, history tells us exactly who wins. It is critical to understand why this setup is so dangerous for traders using leverage, even if they are directionally right. This is what pros call the widowmaker zone, not because the trend is wrong, but because volatility is designed to punish impatience. When markets move from speculation to institutional stacking, price behavior shifts. Moves become faster, sharper, less forgiving. You see drops that feel engineered because they are. Big players know where leverage sits. They know where stops are all clustered. And they know that forcing liquidations is the absolute fastest way to acquire inventory. This creates a brutal paradox. The more bullish the long-term setup, the more violent the short-term swings become. That is how strong hands are separated from the weak. A $10 drop in minutes can occur in a market screaming higher. If you are over-leveraged, that single wick ends your participation. Physical stackers experience this very differently. They don't watch every tick. They don't face margin calls. Volatility doesn't threaten the stack, it validates it. That distinction is everything. This is why patience is a strategic weapon. Institutions endure drawdowns as they aren't trading for days. They are reallocating for cycles. When volatility spikes, they do not panic. They deploy capital. For the average stacker, survival matters more than timing. You don't need to capture every dollar of upside. You need to stay in the game long enough for the thesis to play out. The tragedy of leverage in a breakout is that you can be right on every macro input and still lose everything if you can't withstand the swings. This phase doesn't reward aggression. It rewards sheer durability. We now arrive at the point where evidence replaces theory. Everything discussed so far, institutional pressure, physical demand, banking, stress, converges in one place: delivery data. This is the hard proof, and right now that proof is flashing red. In a normal December, silver deliveries are an afterthought. Contracts roll, positions settle in cash. Volume fades into the background, but this time something unprecedented happened. Holders refused to roll. They refused cash. They demanded the metal. Contracts standing for delivery surged to levels that simply do not belong in a holiday month. This is not speculative behavior. Speculators don't want pallets transport and storage. They want price exposure. These requests come from entities that need the metal itself, not the trade. This is where the scam breaks. Futures markets are built on fractional reserves. Multiple claims exist on the same ounce because historically almost nobody demands it. When a small group converts paper to physical, the system strains. When that group grows, the system fails. Every bar leaving a registered vault removes leverage from the market. It can no longer be promised to anyone else. It can no longer be used as collateral. The paper pyramid begins to collapse from the bottom up. This is why delivery data beats technicals. It tells you the problem isn't price discovery, it is supply discovery. And supply discovery doesn't happen smoothly. It happens through repricing. Markets can ignore charts. They cannot ignore empty vaults. Right now, the vaults are sending a clear message that no amount of paper selling can silence. This is the moment the story stops being about silver alone and starts being about the architecture of the entire financial system. When a tiny market like silver stresses banks' funding desks and collateral chains, it reveals the truth. The system is far more fragile than it appears. Modern finance is built on leverage upon leverage. Assets are pledged, rehypothecated, reused as collateral. Silver isn't just a commodity here, it is a building block. When that block is removed via physical delivery, the leverage stack above it begins to wobble. This is why silver stress spills into funding markets. When a bank cannot meet delivery obligations cheaply, it must raise cash. To raise cash, it sells assets or borrows overnight. That pressure shows up immediately in short-term funding rates. What looks like a metal problem becomes a balance sheet problem. Here is the critical insight. Central banks can provide liquidity, but liquidity is not supply. They can print currency. They cannot print atoms. Every dollar injected to stabilize the system weakens the currency denominator. Silver is priced in. That doesn't resolve the imbalance. It intensifies it. This creates a policy paradox. Allow prices to rise, banks bleed. Suppress prices with liquidity, currencies bleed. Either way, nominal prices of scarce assets must go higher. This is why markets stop responding to reassurance and start responding only to flows. When investors realize the safety net itself accelerates the move they try to contain, confidence shifts rapidly. Capital moves from promises to possession, from paper claims to physical reality. This is how regime changes start. Quietly at first, then all at once. Once trust shifts, it doesn't return easily. The market is no longer debating whether silver should be higher. It is pricing how broken the old assumptions have become. We arrive at the final question: how do you survive and benefit from a market like this without becoming collateral damage? Moments like these don't just create opportunity. They test discipline, psychology, and time horizon. First, understand this clearly. What you are witnessing is not a normal bull market. It is a transition, a shift from a paper-dominated pricing system to one governed by physical constraints. Such transitions are never smooth. They are volatile by design. They shake confidence. They punish leverage. And they reward patience. The biggest mistake people make in environments like this is confusing speed with risk. Yes, the price moves fast, but speed does not equal fragility. In fact, when prices rise alongside rising physical demand, the foundation is stronger than it looks. Volatility is not the enemy here. Overexposure is. Second, zoom out. Daily candles are noise. Weekly structure is signal. As long as physical demand persists, delivery pressure remains elevated and institutional models continue to flag silver. As mispriced, the path of least resistance remains higher regardless of short-term chaos. Third, think strategically, not emotionally. This isn't about predicting the exact top or catching every dollar. It is about positioning yourself on the right side of a structural shift. History shows the largest gains in real assets don't come from trading. They come from holding them through periods when confidence in paper systems erodes. Listen closely, stackers. Real wealth transfers never announce themselves politely. It feels uneasy holding while fiat burns, but hindsight is 20/20. The winners aren't loud. They are the ones quietly stacking heavy ounces and staying prepared. If you track this, you're ahead of the herd. Stay patient. Keep stacking. Respect the tamp downs, but do not fear them. The system isn't breaking, it's just revealing the real cost of physical silver. If this helped you see the real money game, smash the like, subscribe to our channel, and share it with someone who still thinks this silver move came out of nowhere. And in the comments below, type 1 if you are stacking for the long haul or 2 if you are still watching the paper price.